In the summer of 2005, Refco was the biggest independent futures broker in America, the largest single broker on the floor of the Chicago Mercantile Exchange. 200,000 customer accounts, more than $4 billion of client money moving through its books. On the 11th of August, it went public. The stock priced at $22 a share, and it jumped about 25% on the very first day of trading. Champagne on Wall Street. A British chief executive named Philip Bennett watching the ticker climb. 67 days later, Refco was bankrupt. Not a market crash. Not a rogue trader on a desk somewhere. For at least 7 years, Bennett had been hiding roughly $430 million of bad debt inside a company he secretly owned. And at the end of every quarter, for just a few days, he made that debt disappear so that no auditor and no investor ever saw it sitting there. He is serving 16 years. This is how the oldest trick in accounting took down a Wall Street machine. Refco did not begin on Wall Street. It began in 1969 as a cattle and commodities brokerage in Chicago, founded by a man named Raymond Earl Friedman. The original name was Ray E. Friedman and Company. Shorten that, and you get Refco. It grew up under Friedman's stepson, Thomas Dittmer, and under a man named Tone Grant, who became its president. Hold on to that name, Tone Grant, a person, a human being who ran this firm. We will come back to why the name matters. Philip Bennett was British. He would later settle in Gladstone, New Jersey, but he came out of the older world of international banking. He joined Refco in 1981, and he worked his way up the inside of the building. In 1998, he became chief executive. By then, Refco already had a rap sheet. This was a firm the regulators knew by name. In 2001, the National Futures Association ordered Refco to pay about $43 million to 13 investors over bogus order tickets. In May of 2005, only months before the public offering, the SEC sent a warning notice over short selling in a company called Sedona, and Refco quietly set aside about $5 million against it. So the pattern was already there in plain sight. A big, fast, aggressive brokerage that kept running into the rules. What nobody outside the building knew was that the real problem sat much deeper, and it had a number attached to it. $430 million. Here is where the rot started, and it started with losses. From at least 1998, Refco was carrying customer and trading losses that were never going to be paid back. Accounts that had blown up. Some of it came from customer accounts linked to the trader Niederhofer, positions that had gone to zero and left nothing behind. Debts that were simply worthless. On an honest balance sheet, losses like that get written off and everyone can see the wound. Bennett did something else. He moved those bad debts into a separate company called RGHI, Refco Group Holdings, Incorporated. And this is the single most important fact in the whole story, so hold on to it. RGHI was not part of Refco. It was not a subsidiary. It was a private company that Philip Bennett secretly controlled. He owned half of it from around 1999, and then he owned the whole thing. Before that, he had co-owned it with Tone Grant, so the losses did not vanish. On paper, they turned into something that looked almost respectable. Refco's books now showed money owed to Refco by RGHI, a receivable, an asset. Instead of worthless trades, the ledger showed a debt that another company owed them. The problem was that the other company was, in effect, Bennett himself, and that company had no real way to pay. Early in 1999, RGHI even sold a 10% stake in the Refco Group to an Austrian bank called Buyout. a bank that would soon become part of the machinery of the trick. For years, this stayed a quiet private problem inside a private firm. Then Refco decided to sell itself, and the hidden debt suddenly had to survive daylight. In August of 2004, the private equity firm Thomas H. Lee Partners led a buyout worth about $1.9 billion. They took a 57% stake for roughly $453 million in equity, and the deal valued Refco at around $2.25 billion. Bennett stayed on as chief executive, and right before the deal closed, he bought out Tone Grant's share of RGHI, so that the secret company was now entirely his own. 2 months later, in October of 2004, the chief financial officer, Robert Troston, walked out the door with a payout reportedly worth around $45 million, a figure that never made it into the offering documents. Then came the main event. On the 11th of August 2005, Refco went public, 26.5 million shares at $22 each. The stock closed about 25% higher on day one, valuing the firm at roughly $3.5 billion. The offering itself was worth about $583 million, but Refco, the company, only sold 12.5 million of those shares, about $275 million. The rest was insiders, cashing out on the way up. Credit Suisse, Goldman Sachs, and Bank of America ran the books. Nobody flagged the hole. So, how do you hide a bad debt worth $430 million from auditors, from bankers, from the whole machinery of a public stock offering? You do not hide it all the time. You only hide it on the days when someone is looking. This is the entire trick, and it is almost insultingly simple. A company's books only get frozen and photographed at the end of each reporting period, the end of the quarter, the end of the year. Those are the only dates that show up in the financial statements. On every other day, nobody outside is checking. So Bennett made the RGHI debt disappear on exactly those dates. Just before each period closed, a short-term loan shifted the debt off RGHI and onto somebody else, some third party. On the reporting date, the books looked clean. The embarrassing loan to the boss's private company was simply not there. Then, a few days after the period ended, the loan reversed. The debt quietly walked back home to RGHI, and it sat there, growing, until the next deadline arrived. The SEC later described it in flat, clinical language. Bennett used short-term transactions that, quote, temporarily moved the debt from RGHI to third parties at the ends of fiscal periods. End quote. That is the whole fraud in a single sentence. Somebody had to lend the money for those few days. That is where the outside players came in. The early version ran through the Austrian bank, Buyout, the same bank that had bought that 10% stake back in 1999. Around each year end, from 2000 through 2005, the loans that carried the debt off the books were largely funded by Refco itself, through its own unregulated offshore unit, Refco Capital Markets. Buyout simply added a slice of money for a fee and put its name on top. In plain terms, the firm was quietly lending itself the cover it needed. Reportedly, about $1.65 billion in total loans ran through that channel over the years, at a cost of roughly $347,000. Then came a cleaner tool. Starting in 2002, a Refco subsidiary would lend money to a small hedge fund in Summit, New Jersey, called Liberty Corner Capital Strategies. Liberty Corner would lend that exact same money straight on to RGHI. When the dust settled, the books showed a nice, ordinary-looking loan to a hedge fund, and the boss's private company was nowhere in sight. The trade press pinned down one of these loops precisely. Liberty Corner borrowed $335 million at 2.5%, and it lent the identical amount to Refco Group Holdings at 3.25%. Then, RGHI's repayment flowed straight back to Refco, which left Liberty Corner sitting on the books as the apparent borrower while the boss's private company slipped out of the frame. The whole loop lasted about 10 days, and it netted Liberty Corner a fee of $90,000 for doing nothing but standing in the middle. To make the fake receivable look alive, Refco booked fictitious interest income on it and dressed it up with sham foreign exchange trades. The loan paperwork was drawn up by an outside lawyer, Joseph Collins, a partner at the firm Mayer Brown. And the auditor, Grant Thornton, signed off year after year and missed all of it. The bankruptcy examiner later said a properly skeptical auditor, quote, would have detected the fraud. A fraud like this only needs one honest set of eyes. In the autumn of 2005, a newly hired controller named Peter James was working through the books, and he found something that did not add up. A repayment recorded on the ledger that had never actually been executed. The money had supposedly moved. It had not. Pull that one thread, and the whole hidden receivable begins to come apart. On the 10th of October 2005, Refco put out a statement that detonated the company. In it, the firm disclosed a receivable of about $430 million owed by, quote, an entity controlled by Philip R. Bennett. The debt was, in their own words, in major part uncollectible, and it dated, quote, as far back as at least 1998. And there was one last detail, almost impossible to believe. Bennett had already repaid the whole thing, in cash, including all of the accrued interest. The disappearing act performed one last time, in front of everyone. It did not save him. The board put Bennett on leave. The stock, a Wall Street darling only 2 months earlier, collapsed. Within days, the man who had run Refco was no longer running anything, and the real questions were only beginning. After that, it went fast. On the 12th of October, 2 days after the disclosure, Philip Bennett was arrested and charged with securities fraud. On the 17th of October, Refco and 23 of its affiliated companies filed for Chapter 11 bankruptcy protection in New York, 67 days after the champagne. The first filing threw out a headline number so large, around $49 billion, that it briefly looked like one of the biggest bankruptcies in American history. But most of that was customer assets, not the company's own whole. The revised petition told a soberer story, about $16.5 billion in assets against roughly $16.8 billion in liabilities. The one genuinely valuable piece, the regulated futures business, was auctioned off. A firm run by J.C. Flowers put in a lead bid worth about $768 million, but it was beaten at the auction, and a rival called Man Financial walked away with the prize for less. The surprises were not finished. In March of 2006, another $525 million of fictitious securities surfaced, held offshore through shell companies on the island of Anguilla, a completely separate strand of fakery, and the investors who had bought into that shiny public offering only 2 months earlier were wiped out. Even Thomas H. Lee Partners, sophisticated private equity, watched its $453 million bet vaporize. So who paid and how much? Start with the man at the center. Philip Bennett pleaded guilty on the 15th of February 2008 to all 20 counts against him. Conspiracy, securities fraud, wire fraud, bank fraud, lying to his own auditors, false filings with the SEC, money laundering. On the 3rd of July 2008, a judge sentenced him to 16 years in federal prison and ordered him to forfeit, in the government's own words, quote, up to $2.4 billion. That figure is not the size of the hidden debt. It is the government's estimate of the total damage. Then there is Tone Grant, the former president, the man who once co-owned the secret company alongside Bennett. Not the auditor, not a firm with a similar name, but a person who was in it from the early days. Grant took his case to trial and lost. In April of 2008, he was convicted, and he was sentenced to 10 years. He never got out. Tone Grant died in prison in January of 2015 at a federal medical center in Rochester, Minnesota. Two men who built the same lie. One got 16 years, and one got a headstone. And then the endings turn uneven, which is where these stories usually turn cold. Robert Troston, the chief financial officer who left with that quiet payout, pleaded guilty and then cooperated with prosecutors for years. In May of 2014, he was sentenced to time already served. No prison. Santo Maggio, an executive over the offshore unit where so much of this lived, also pleaded guilty and cooperated, and he settled a parallel case with the SEC. The outside lawyer, Joseph Collins of Mayer Brown, had the strangest ride of all. Convicted in 2009 on 7 counts, sentenced to 7 years, then the Second Circuit threw the conviction out. He was retried, convicted again in 2012 on 4 counts, and finally sentenced to 1 year and 1 day. And the auditor, Grant Thornton, the firm that signed off and missed the hole, never criminally charged. It settled the civil claims, including a securities case worth roughly $25 million, and it moved on. Here is the part worth sitting with. Nobody in this story needed to be a genius. There was no exotic instrument, no secret math, just a real debt, a private company nobody knew the boss owned, and a calendar. Bennett hit a $430 million hole on the one day of the year anyone bothered to look. He did it for 7 years, and it worked, right up until the morning someone opened the books on an ordinary day. This has been Cooked Books. The culprit, as always, was the numbers.